Hi, I'm Jeff Tucker, the principal economist at Windermere Real Estate, and these are the numbers to know right now. The first number this week, 3.84 million. That is the annualized pace of existing home sales in September, according to the National Association of REALTORS. And that was below expectations. It's also down 1% from the sales pace in August and down 3.5% year over year. So this was a disappointing report. It's a measure of just how frozen the real estate market still is, largely due to high interest rates discouraging sales activity. Now, surprisingly, the median price of existing homes sold in September still climbed 3% year over year, up to $404,500. It's not a very fast pace of appreciation. In fact, it's right around the pace of overall inflation in the country at the moment. But the fact that it's still positive suggests that this is a fairly balanced market between buyers and sellers. Another indicator of a balanced market this month was inventory. There were 4.3 months of supply in September, up from 4.2 in August, and that's even a little bit more than there were in September of 2019. So now we can finally say that buyers are not facing unusually low inventory, arguably for the first time in about 5 years. Now, one final wrinkle in the existing home sales report was that the West was the only region that bucked the downward trend. Here in the West, sales actually rose 5.6% year over year. It's not totally clear why, but it might reflect buyers in the West reacting a little more quickly to the drop in interest rates through August and early September of this year. Now, that brings me to the second number to know this week, 6.92%. That's the latest 30-year mortgage rate as of Wednesday, October 23rd, according to Mortgage News Daily. Now, that is up close to 4/5 of a point from where it was a month ago. It reached a low of 6.11% on September 17th, though it is still down about half a point from a peak back at the end of April and early May of this year. So there have been a couple sharp upward movements in mortgage rates over the last month for a few reasons. First, we talked about this before, but the strong September jobs report and somewhat firm inflation data for September both helped to shrink the perceived risk of a recession and the chances of the Fed continuing to cut interest rates really aggressively from here on out. And secondly, it's starting to seem like uncertainty around the election is creeping into the bond market and pushing up yields, maybe also due to expectations of higher deficits from the government next year. And all of that together is kind of creating a perfect storm for interest rates to rise in the last month. All right, that is all for this week. Thank you for watching, and don't forget to subscribe.